Hey folks, Dan Frio here with your real estate update for January 18th, 2024. Got it right that time. So we're going to talk about today is basically going to be just economics 101. I'm going to explain to you guys how supply and demand works. So before you turn that dial, I think you're going to get a lot out of this because it's going to explain to you what's going to go on with interest rates and what's going to go on with home prices. So if that's what you're looking for, stay tuned because that's what we're going to go over. So my name is Dan Frio. I do this report on a daily basis. I'm a mortgage advisor licensed in all 50 states. So if you're out there trying to buy your first house, maybe in 2024, I'd love to help. So without further ado, let's get over to our context. So what you're seeing right here are the top 6 programs people use when they're buying their first house. The gist behind all this is they're not my rates. They're not any individual bank's rates. What they are is Mortgage News Daily surveys lenders all over the country and asks them these 5 questions. If you had a borrower that was looking to buy their first house, it was a single family home, and it was going to be their primary home, and then they had a 780 credit score, yes, 780, and they were putting down 25%. That'd be the rate. Is that you? Probably not. So at the end of this video, I'll give you all of my information so you can reach out to me for some help. But without further ado, let's get over to the news that we have today that's affecting the markets. So we do on a daily basis, we go over to our economic calendar. And in today's events, there is a lot on the mix. You can see Thursday, January 18th. What we're going to focus in on today is basically the supply of something and the demand of something. Okay, so let me get to it. Let's first start talking about the supply and demand, okay, of housing units. We all know there's a shortage. If you don't believe me, do all your research because there is a housing shortage. Reason why is existing homeowners aren't putting their houses on the market. Rates are too high. When rates get down to about 5.5%, I think you're going to see more and more homes coming to the market. Thus, that'll help the market prices with things, not continuing to go up and up and up. But one of the big factors we're going to talk about today is jobs. Jobs is one thing that the Federal Reserve really monitors, and here's the reason behind this thing. What they're saying is weekly jobless claims post their lowest reading since September of 2022. This is driving the Federal Reserve nuts because why? Labor strength has persisted despite attempts by the Federal Reserve to slow the economy, the jobs market in particular, through a series of interest rate hikes. So here's what they're trying to do, and this is right here from CNBC. Their thought is if they raise interest rates high enough, it'll stop people from spending so much. Okay, so if you're not spending as much, buying as much stuff, that stuff doesn't need to be produced. Okay, so that means the job force can be kind of limited. They can start getting rid of people at work because we don't need as much stuff. That is saying right there. That's what it says. Okay, so let's go back to the data. You see right through here, initial jobless claims. We have, so people that filed for the first time, it was last reading was 203,000. Now the Federal Reserve wants this to hit like 300,000. So last reading was 200,000. They expected it to tick up just a little bit to 207 and actually dropped, okay, to 187. And then continued claims. How many people are still continuing to get unemployment, didn't go back to work? Well, that's also depleting. Went from 1.832 million. They expected it to tick up a little bit, and it actually went down. Okay, so that means there's more people in the workforce driving the Federal Reserve nuts. Okay, so now that's going to say, well, unless that really happens, the Federal Reserve is not going to cut rates. And that's why the markets are reacting the way they are. So now let's get over to home prices, because that's a lot of times what you're interested in as well. So right now we don't have enough product on the market, and house prices in most areas continue to go up, even though we had a huge rally over the last couple of years. Reason being is supply demand. Okay, let's go over here. Just the supply demand. What causes a price to drop? It doesn't matter what it is. It could be a widget, it could be cars, it could be homes, whatever. It says with more goods produced than demand. So you have to have too much of a product and less demand for that product. So what you go over here is what's the gist of what's going on right now. So we look at building starts. So home starts month over month. Last reading, it was up 10%. New reading, it's down 4%. So it was up 10%, now it's down 4%. That's almost a 15% drop in the number of housing starts. So that means we're going to have less homes on the market. And so what's going to happen to the prices? If you have less of a product and you still have the demand, well, the opposite of this, it's going to cause the prices to go up. And this is driving people nuts, especially the Federal Reserve. So that's why right now, the things that the Federal Reserve is doing, they're not really thinking it's working. So there might be a little bit longer time period where the Federal Reserve holds rates higher than we anticipated. So that's basically the news today that we're facing. So with that information, let's go over to the stock market and the bond markets and actually the trading markets. And here's what my screens look like on a daily basis. So I use a system called MBS Live. The reason being is, like I said earlier, I'm a mortgage advisor. My job is to know mortgage products, and I think it's also my job to know what in the heck's going on with mortgage rates. So how do we do that? Well, we follow the mortgage bond. MBSs. It's called an MBS. The MBS means mortgage-backed security, trades on Wall Street. You might even have some of this in your 401k. So what this is I want to explain to you. This bond right here is the deterrent of what determines your interest rate on your mortgage. Okay, so the yield on this bond is the biggest component of your mortgage rate. So we follow this bond in particular. So right now what you're seeing is the price is 101.05. It is down 0.03. If you know anything about the bond market, if the prices go down, what's going to happen to rates? They're going to go up, correct? So if there's a yin-yang effect, prices go down, yields or rates go up. So we love when prices go up. That's what we've seen from November, actually part of October, all the way through just recently. Look at this rally. Prices were down here, and the rates were 8%. Rally, 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 and now we're right up through here. Rates are what? They're right over here at about 6.88%. We're teetering back on the 7% range. Will we get there? I don't think we get there. If we get there, we'll teeter off of that and come back down until more and more data comes out that the Federal Reserve is really interested in. So that's it right there. So one other thing is I want to show you guys is, and I forgot about this piece of it, we also want to figure out why interest rates are going up. Okay, so interest rates, like I said, right here, they're a bond that trades on Wall Street. Okay, what do they compete with? Are they the only bond on Wall Street that investors can buy? No, they can also buy government bonds and corporate bonds. So again, what causes the price of something to drop? Again, if you go through here, more goods or more of the product produced than the demand is. Well, let's look at the federal government. How much did the federal government issue in bonds competing against the mortgage-backed security bonds and Treasury bonds? Right here. Year-to-date statistics include the government issued $22.7 trillion in bonds last year, 35% increase. Okay, so that means there's 35% more of this product out in the market, a bond. So what happens to those bond prices when you don't have enough investors to buy? Prices go down. What do we know with that? Prices go down, rates go up. So that's my biggest concern in 2024 is government spending. So you can understand now why and how that plays an impact on mortgages and mortgage rates. So without further ado, let's get over to me. If you're out there and you're like, hey, Dan, what do you do? Well, I explained at the beginning of the video. I'm actually a mortgage advisor. I'm licensed in all 50 states as well as Puerto Rico. I'd love to help you if you're kicking the tires to see, can I buy a house in this market with the prices the way they are, with interest rates the way they are, with my credit and my income? Well, please reach out to us. We'd love to help. How do you do that? Well, the first one is hit the apply now button. What it's going to do is it's going to ask you just a couple questions before you put in an application. We want to know a little bit about you. We want to answer any questions that you have before you take 15 minutes to fill out an application. So check that out. You're going to be set up with a consultation with one of our mortgage advisors to answer all your questions before you actually apply. Next thing is if you want to reach out to us directly, how do you do that? Well, you can scroll down to the bottom of our website. You're going to see mortgage calculators, blogs, and all kind of other stuff, but it's going to give you our phone number as well as my email address. And yes, this is me. And if you email me, I promise you I'll email you back. Most of the time I do it in video form, kind of like this, just to make the response a little bit more entertaining, and it might make a little more sense if you see it in video form. So thanks so much for watching, guys. If you haven't subscribed yet, please do that right down below. And other than that, I hope to see you here tomorrow and with hopefully some more good news to explain real estate to you in 2024. Take care. Have a great day. Bye-bye.